Ruchir Sharma, The Rise and Fall of Nations, Forces of Change in the Post-Crisis World. As we navigate the unpredictable world of economic cycles, Ruchir Sharma's The Rise and Fall of Nations, Forces of Change in the Post-Crisis World offers thought-provoking insights into the factors that influence these trends. The book challenges the optimism surrounding emerging markets, particularly the BRIC countries, Brazil, Russia, India, and China, which were expected to reshape the global economy. Topics such as the impact of population growth, the role of manufacturing, currency valuations, and the effects of political policies on nations' economic performance demonstrate the impermanence of global markets.
The Rise and Fall of BRICs. The financial crisis of 2008 was a turning point for the emerging markets, particularly Brazil, Russia, India, and China, BRICs, that aimed to become the new economy. Unfortunately, their success ended shortly, and their economies are now faltering. China, once growing at 14%, is now experiencing less than 5% growth, while Brazil and Russia's economies are shrinking. As a result, the acronym BRICS has become a bloody ridiculous investment concept. The book suggests that economic booms and busts have been happening for centuries, and impermanence is fundamental in global markets. Investors cannot rely on economic predictions that look beyond 5 or 10 years, as many factors may cause things to turn unpredictably. Overall, the book explains that the global financial crisis has changed the course of history and that political freedoms may decline as economic crises occur. Population growth and economic development. The connection between population growth and economic growth is crucial. Countries with growing populations can experience economic booms, while those with shrinking populations face labor shortages, pension fund holes, and economic slowdowns. The world's population growth rate has been decreasing since 1990, and only Nigeria is projected to see growth in its working-age population. Although adding workers is essential for economic growth, China, Poland, and Russia have managed to sustain economic growth despite low population growth. However, the recent decline in China's workforce suggests that the country's growth may not be sustainable. In the current political climate, many politicians still blame foreigners for local financial crises. However, it is important to acknowledge the impact of population trends on economic development, especially as the economic and political cycles continue to govern the future. Demographics and economic growth. Demographic trends play a crucial role in shaping economic growth, but political leadership and policies are key factors in realizing the demographic dividend. Arab nations failed to capitalize on their demographic boom due to inadequate policies. Countries like Australia, France, and China have tried various measures to control population growth with mixed results. Aging populations pose challenges to developed nations, who are gradually raising the retirement age and encouraging immigration. In emerging nations, investment growth and strong manufacturing sectors are driving economic growth. While location can pose challenges, trade-friendly policies and infrastructure development can overcome geographic deficits and open up opportunities for growth. Despite fears of automation and job losses, most people will adapt and find new roles. Putin's economic missteps. Vladimir Putin implemented successful economic policies that propelled Russia's growth, but his failure to diversify and prioritize power over growth led to economic decline. Putin's initial policies of a flat tax and focusing on fossil fuels brought about a decade of hypergrowth and increased incomes. However, Putin's later populist policies, such as a generous pension plan and prioritizing military conflict over economic diversification, hindered Russia's growth. As Putin shifted his focus to retaining power, Russia's once miraculous economic growth fizzled out. The power of productivity in manufacturing. The manufacturing industry plays a vital role in a country's economic growth. China, South Korea, Malaysia, and Indonesia are success stories that utilized manufacturing as a significant driver. In China, 30% of GDP comes from manufacturing. Increasing productivity is crucial in the manufacturing sector. When factories produce more with the same workers, factory owners can provide raises without inflation. Commodity versus manufacturing-driven economies. The value of manufacturing in developing nations and the downside of commodity-driven economies is explored in this summary. The success of manufacturing is contrasted with the failure of commodity-driven economies like Russia and Brazil. However, the manufacturing industry's significance is reduced as economies become more mature. Although autocracies are considered better at generating long-term growth, state interventions in the economy can either be productive or destructive. Brazil's economy became so strong that Brazilian tourists traveled to New York on shopping sprees, but this successful run was short-lived. By letting their currencies overheat during the commodities boom, many emerging markets like South Africa and Russia fell into the trap of moving money overseas, leading to less investment, expensive exports, and a weakened economy in currency. Currencies are compared using metrics like inflation rates and Big Mac indices, but these have flaws. The article ends on a hopeful note, saying nations can redraw the map of global trade routes for their advantage by implementing the right policies and political will. The impact of current account deficits. Assessing a nation's money flow begins with the value of its currency against the dollar. While the trade balance is the prominent component of most countries' current accounts, other factors like foreign aid and interest payments impact currency valuations. When a country's current account deficit surpasses 5% of the GDP, it implies trouble. Since 1960, 40 countries experienced a slowed economy after 5 years of exceeding the 5% level, leading to an eventual crash. This benchmark applies to both rich and poor economies, such as Norway, South Korea, Poland in the 1980s, and Turkey more recently. Thailand's economic downfall. In the early 1990s, Thailand pegged its baht to the dollar, leading to a local bubble. When China devalued its currency, Thailand lost its competitiveness, and the baht became expensive. Foreign investors pulled out, and Thailand abandoned the dollar peg in 1997, causing the baht to plunge 50%. The country's debt inflated much faster than its economic growth, exemplifying the dangers of prodigious borrowing. Private borrowing as an economic indicator. Private borrowing as a percentage of the economy is a key indicator investors follow. Ireland's private credit surged 160% from 2004 to 2009, while Greece's private debt grew from 69% to 114% from 2003 to 2008, preceding its economic collapse. China's unstable economy. China's pursuit of unsustainable growth has created a debt bomb with a property bubble deflation and stock bubble inflation. The use of shadow banks and collateralized loans unrelated to ability to repay have contributed to this economic instability. Furthermore, investors in China have been indulging in exorbitant valuations based on hopes that values would grow. The telltale symptoms of a stock bubble are the value's disconnection from economic growth, investors borrowing to buy shares, everyday investors trading too much, and exorbitant valuations becoming common. These signs are rampant in China today.
Sharma's The Rise and Fall of Nations serves as a compelling reminder that the world's economic landscape is ever evolving, and the importance of understanding factors that influence economic growth and decline. The frailty of emerging markets, the growth-driving aspect of thriving populations, the significance of manufacturing and currency valuations, all contribute to a nation's economic stability. This book emphasizes that there is no single formula for success and that every nation's economic progression is determined by a myriad of factors. Reflecting on the complex interplay of these aspects can help us make sense of the global economic jungle, enabling us to anticipate the rise and fall of nations with better understanding.